If you were told that a single bank could shake the entire global silver market so violently that the price of silver might rocket to unheard of levels, even above $300 an ounce, would you believe it? Today, we're diving into a story that sounds like a financial thriller, but it is breaking into real markets right now. A perceived HSBC silver margin crisis with whispers of delivery failures. Massive short positions in a market that could be on the brink of its biggest historic squeeze. This isn't just about metal. It's about trust, leverage, physical delivery, and the tension between paper trading and real-world scarcity. Let's slow down and unpack it from the beginning. For decades, silver has been one of the world's most important precious metals, beloved not just by collectors and coin buyers, but by industries. Solar panels, electronics, automotive components. Silver's conductive and reflective properties make it indispensable. Every year, about 800 million to 840 million ounces of silver are mined globally, but demand, including industrial use, recycling, and investment, pushes that higher, often creating a deficit where consumption outpaces production. In fact, global silver markets have seen consistent deficits in recent years, with millions of ounces drawn down from above-ground inventories to fill the gap between supply and demand. Now, let's introduce HSBC into the picture. HSBC is one of the world's largest financial institutions and has long been a major player in the London bullion and precious metals markets. In markets like silver and gold, major banks and clearinghouses facilitate trading, storage, and, crucially, delivery for contracts. Traders and investors don't always take physical delivery of a metal. Often they trade paper contracts whose value is tied to the commodity. But when traders do demand physical delivery, especially in stressed markets, that's where things get interesting. Over the last several years, there have been multiple reports in trader forums and market analysis circles pointing to unusually high delivery notices tied to HSBC customer accounts on silver futures contracts, implying significant short positions. That is, positions that profit if prices fall, that may not have readily available physical metal to deliver. Now hold that thought while we understand what a short position means in precious metals. When someone shorts silver futures, they are essentially agreeing to deliver metal at a future date in exchange for payment now, betting that the spot or market price will be lower later. If at delivery time they cannot procure the metal cheaply, or at all, they run the risk of either being forced to buy at higher prices to fulfill contracts or being unable to deliver, which can lead to technical defaults or squeeze. This is where the idea of a margin call comes in. In futures trading, if prices rise sharply, short sellers must post more collateral, called margin, to maintain their position. If they cannot, the clearinghouse can force liquidation of positions or cancel them, which in turn can drive prices further as shorts scramble to cover. In a normal market, this mechanic keeps both sides honest. But in a market where physical delivery demand suddenly spikes, the tension between paper markets and physical markets can explode. Here's where the alarm bells began ringing in trader communities. And among some analysts, reports of delivery failures, where a party cannot or does not deliver metal against a contract, on silver futures, particularly tied to HSBC client positions. These reports suggested that hundreds of contracts went undelivered as the delivery window approached, and that a large cumulative short position remained outstanding with insufficient physical silver backing it. When delivery notices jumped higher, the implication was that someone, possibly a dominant short, such as an HSBC customer account, was issuing notices without clear inventory backing. Of course, let's not lose sight of real, publicly reported market fundamentals while we parse rumor and forum chatter. Independent data from the Silver Institute and market surveys show that the silver market has been under structural pressure. For several years, consumption has outstripped mine production plus recycling, resulting in significant drawdowns of inventories held in London and New York vaults. So much so that the amounts of silver available for immediate delivery, registered stocks, have declined sharply. In the futures market, this is manifested in periods of backwardation where spot prices are higher than futures, signaling tight physical conditions with demand for metal now exceeding availability. When you combine tightening physical inventories, high demand from industrial users and retail investors, inflows into silver ETFs, and large speculative positions, the stage for stress is set. Now layer on a narrative of a megabank potentially on the hook for a huge short position, one that might be difficult to cover if the market suddenly demanded delivery. Speculative figures circulating in online communities, such as 4.7 billion ounces short or extreme price projections above 300 per ounce, are not official exchange data, and credible reporting does not validate that specific number as a fact. But they do underscore how stressed and thin the market could feel to participants when real physical metal becomes scarce relative to paper obligations. To bring this back to tangible terms, imagine a marketplace where people have promised more apples than actually exist in the orchard. If suddenly a flood of customers shows up demanding real apples, not IOUs, The price of what apples remain is going to skyrocket, and those who promised apples they don't have will be scrambling, forced either to buy at outrageous prices or face penalties. That is essentially the short squeeze mechanism that traders fear in silver when delivery pressures rise and inventory is tight. And then there's the question of margin calls. A margin call in futures markets doesn't happen because of rumor. It happens when the clearinghouse identifies that the value of a position has moved against the holder such that the posted collateral is insufficient. Historically, exchanges like COMEX adjust margin requirements during periods of high volatility to protect market integrity. In late 2025, for example, COMEX increased initial and maintenance margin requirements on silver futures in response to elevated volatility, a normal risk control measure, which in turn affected leveraged traders. But the dramatic imagery of a bank facing an emergency margin call at a specific dollar price, like $312, is not something reflected in publicly verifiable exchange or regulatory filings at this time. It is part of the narrative, circulating among certain market observers, not confirmed official data. What is clear is that a perfect storm of real market stress, constrained inventories, robust demand, speculative positioning, and a disconnect between physical and paper markets can create explosive conditions ripe for sharp price moves and liquidity events. What does all this mean for everyday investors and watchers of the precious metals markets? First, it's essential to differentiate between what is documented in official market data, like inventory trends, deficit statistics, futures market behavior, and what is speculative or anecdotal. Second, understanding the mechanics of futures markets, short positions, delivery and margin, can empower you to see why rises in prices are not just random, but reflect deep structural forces. Third, historical episodes, like the famous Hunt brothers cornering attempt in 1980, show us how fragile markets can become when physical demand outpaces supply and leveraged players are on the hook. Most importantly, it shows that stories like Bank on the Brink resonate not just because of dramatic headlines, but because they tap into real mechanisms that govern modern commodities markets. Context is everything when you start connecting the dots between supply deficits, short positions, and the mechanics of a potential silver squeeze. To understand why a margin call or delivery failure could have such seismic effects, it's important to visualize how much physical silver actually exists versus what is being promised on paper. According to the most recent data from the Silver Institute, above-ground silver stocks, that is, all the silver held in vaults, banks, and private holdings, hover around 1.5 billion ounces. Meanwhile, the futures market alone represents contracts for tens of billions of ounces, a fraction of which ever changes hands physically. This mismatch between actual silver and paper claims is a structural tension point, the sort that makes traders nervous when one of the big players, like HSBC, might be leveraged far beyond what is realistically deliverable. Consider this analogy. It's like a bank issuing more promissory notes for gold bars than it has stored in its vault. For years, this system functioned smoothly because not everyone demands physical delivery at the same time. But introduce a sudden surge of demand, whether from ETFs, industrial buyers, or opportunistic traders hoping to trigger a short squeeze, and suddenly the illusion of abundance crumbles. Historical precedent is illuminating. The Hunt brothers' silver saga in 1979 to 1980 saw similar mechanics. They amassed enormous long positions, forcing the market into backwardation, and momentarily wrested control over the pricing of silver. When regulatory changes and margin calls hit, silver prices collapsed. But the market lesson was clear. High leverage and constrained physical availability create enormous risk for all players. Now, in HSBC's case, the chatter centers on an alleged 4.7 billion ounce short exposure with Asia delivery failures. While no exchange has confirmed these figures, it underscores the kind of concentrated risk that can exist in the system. Futures contracts tied to COMEX and LBMA are typically settled in cash, but when counterparties demand actual metal, a rising trend as confidence in paper claims wavers, the dynamics shift dramatically. Physical inventories are not only finite, they are geographically concentrated. Vaults in London, New York, and Hong Kong hold the bulk of deliverable silver. If delivery fails in one hub, for example, Asia, which has seen surging demand from industrial manufacturers and retail investors alike, it can create localized shortages that ripple globally, driving prices higher in the process. Let's break down the mechanics of a margin call in this context. Suppose a trader or bank has shorted 100,000 silver contracts at $25 per ounce, effectively betting that prices will fall. Each contract represents 5,000 ounces. If silver suddenly jumps to $30 per ounce due to delivery pressures or rising ETF inflows, the trader now faces a loss of 5 per ounce multiplied by 500,000 ounces. That's 2.5 million. The clearinghouse then demands additional margin to cover the risk. If the trader cannot meet the margin call, positions may be forcibly liquidated, which pushes prices even higher. Multiply this across multiple traders with overlapping exposures, and you can see how a single liquidity crunch or perceived delivery failure can propagate into a market-wide event. The Asia angle is particularly compelling. Asian markets, led by China and India, have increasingly been absorbing both industrial demand and investor appetite. Data shows that Chinese and Indian silver ETF holdings have surged by 15-20% in the last 12 months alone, while physical retail demand in India spikes every Diwali and wedding season. That's hundreds of millions of ounces potentially leaving the exchange system and entering private hands, reducing liquidity in the COMEX and LBMA registered warehouses. In such an environment, any disruption, such as a major bank unable to meet delivery obligations, can exacerbate the squeeze effect. It's the classic supply and demand mismatch amplified by leverage. And then there's the psychological component. Market participants watch large banks like HSBC closely because they can act as bellwethers. If traders believe HSBC or another major player is under pressure, fear and speculation can accelerate price movements even before any delivery issue is confirmed. This is behavioral finance in action. Perceived risk can become as powerful as actual risk. Add in the fact that silver is a relatively small market compared to gold, its daily trading volume, and total market capitalization are much smaller, and the potential for exaggerated price swings grows. For example, the silver market's total annual production of roughly 840 million ounces represents only about 2 to 3% of the notional value traded in its futures market each year. This mismatch makes it much easier for concentrated positions to influence prices dramatically. Let's not forget hedging dynamics. Many industrial users and ETFs hedge their exposure with futures contracts, meaning they may buy or sell in reaction to price movements in the futures market, not necessarily to acquire or offload physical silver. This feedback loop can amplify volatility. So even if the 312 emergency narrative is speculative, the underlying mechanics that could drive dramatic price swings are real. Constrained physical inventory, concentrated speculative positioning, rising Asian demand, and leveraged bank exposures. It's worth illustrating this with a real-world scenario. Imagine a factory in Shanghai needs 100,000 ounces of silver for electronics manufacturing. They attempt to buy futures on COMEX to lock in prices, but available contracts are insufficient, and registered warehouse stocks are low due to previous withdrawals. They are forced to pay a premium on the spot market, which sends ripple effects across all open contracts. At the same time, leveraged short holders, perhaps including major bank accounts, are facing margin calls and scramble to cover by purchasing physical silver at inflated prices. The result? A cascading squeeze, potentially pushing silver far above traditional valuations. But let's balance this with risk reality. Exchanges and clearinghouses monitor these conditions closely. While delivery failures can occur, systemic collapse is rare because margin adjustments, position limits, and regulatory oversight exist to prevent extreme disorder. That said, the system is stress-tested by extraordinary conditions like those implied by HSBC's alleged position and Asia delivery failures. Investors and traders watching these developments should understand both the mechanics and the stakes. It is not just about silver prices moving. It is about understanding why they can move rapidly under tight physical conditions combined with concentrated paper positions. Furthermore, comparing silver to gold helps clarify the stakes. Gold, with a market capitalization exceeding $13 trillion and massive above-ground reserves, is far less sensitive to delivery imbalances. Silver, in contrast, has roughly $1 trillion in total above-ground value and a smaller industrial base, making it far more reactive to shortages or leveraged positions. This is why even rumors of delivery failure or extreme short positions can ignite massive market speculation. Historically, periods of backwardation in silver futures have coincided with sharp price spikes, a reflection of physical scarcity pressing against paper commitments. Finally, a key takeaway. This situation highlights the intersection of market structure, behavioral psychology, and global demand. Even unverified numbers like 312 for emergency or 4.7 billion ounces short illustrate the point that when supply is tight, leverage is high, and demand is surging, markets become highly sensitive to disruption. Understanding the mechanics, futures, shorts, margin calls, physical delivery, and regional demand equips investors to see why dramatic price moves are not just sensational headlines, but plausible outcomes under certain market stress scenarios. It's a rare convergence, and anyone interested in silver should be tracking physical inventory reports, ETF flows, and large clearinghouse positions closely. The broader implication is that silver is not just a commodity. It is a strategic asset with real-world constraints, prone to volatility when structural imbalances intersect with concentrated financial positions. Market participants, from institutional players to retail investors, are increasingly aware that the line between paper and physical silver is not just theoretical. A squeeze, whether minor or historic, can happen in hours or days, driven by delivery failures, margin calls, and investor psychology. And all of this brings us full circle back to the underlying financial tension at the heart of HSBC's alleged position, which continues to be monitored by traders, analysts, and market observers alike. While the specifics remain speculative, the framework for understanding a potential squeeze is clear: low inventories, leveraged shorts, surging demand, regional delivery bottlenecks, and margin call mechanics. Recognizing these forces allows anyone watching the market to differentiate between hype and structural risk and understand why even unconfirmed reports can generate serious attention. Recognizing the subtle dynamics of the silver market is crucial for anyone trying to make sense of this HSBC situation. At first glance, headlines about a $312 emergency or 4.7 billion ounces short can seem like sensational panic. But when you examine the mechanics, the interplay between physical inventories, futures contracts, delivery notices, and margin calls, it becomes clear why these numbers, even if speculative, grab so much attention. The financial ecosystem of silver is not infinitely elastic. It's constrained by real-world supply, storage logistics, and global demand, especially from industrial and Asian markets. When these constraints meet concentrated financial positions, prices become acutely sensitive to disruption. Let's revisit the anatomy of a potential squeeze scenario in simple terms. Imagine a crowded theater with only 100 seats, but 150 ticket holders showing up. Everyone assumes someone will stay home, and most tickets are paper promises rather than actual spots in the auditorium. If, unexpectedly, all 150 people arrive, chaos ensues. In the silver market, seats are physical ounces available for delivery, and ticket holders are traders with short positions. A sudden surge in demand for actual metal triggers a scramble, forcing prices higher, margin calls to escalate, and leveraged players to liquidate or cover. In extreme scenarios, as analysts point out, prices could theoretically surge to levels that seem outrageous in today's market, though regulators and clearinghouses typically intervene to prevent systemic collapse. Historically, we have seen the power of these dynamics play out repeatedly. Aside from the Hunt brothers example in 1980, more recent events include the 2011 silver rally, where prices nearly doubled in months due to ETF inflows and physical shortages. During that period, the market experienced sharp backwardation. Spot prices exceeded futures prices, reflecting tight physical supply. The lesson is consistent. When leverage, speculative positioning, and constrained inventories align, even small catalysts can trigger outsized moves. The alleged HSBC exposure taps into the same structural vulnerability, magnified by global demand from Asia, declining COMEX warehouse inventories, and rising retail and institutional interest in physical silver. Now, the $312 figure, while widely circulated in certain forms, should be understood in context. Current COMEX silver prices are around $28 or $30 per ounce. A jump to $312 would represent a roughly tenfold increase, not impossible in a theoretical margin squeeze, but historically unprecedented under normal conditions. What is meaningful, however, is that large-scale margin calls could force leveraged positions to unwind, resulting in rapid multi-dollar moves, potentially sending silver to levels far above normal trading ranges, even if not literally $312 per ounce. The takeaway is that price projections in these discussions are often intended to illustrate stress potential rather than predict exact outcomes. One critical factor often overlooked is the role of ETF inflows and outflows. Exchange-traded funds holding physical silver have become a significant player in global supply and demand dynamics. In 2025, silver ETFs collectively hold over 400 million ounces, equivalent to nearly half of the COMEX registered warehouse inventory. A large inflow can effectively remove silver from the available supply chain, intensifying delivery pressures, while significant outflows can temporarily alleviate tightness. In a margin call scenario, if shortholders attempt to cover positions through ETF purchases, the pressure can escalate rapidly, as available shares are limited and prices rise with demand. Let's also consider Asian delivery hubs. Hong Kong and Shanghai have increasingly become focal points for physical silver trade. Delivery failures in these locations, as reported in trader circles, can create ripple effects in London and New York. When a contract fails to deliver in Asia, the short party must either locate physical metal elsewhere at a premium or risk default. This transcontinental chain reaction highlights the interconnected nature of global commodity markets and explains why even rumors of localized delivery failures can have outsized market implications. At the individual investor level, understanding these mechanics is essential. This is not just a story for institutional traders. Retail participants are increasingly exposed through ETFs, futures contracts, and even coins and bars purchased via dealers. Awareness of margin mechanics, settlement types, cash versus physical, and market liquidity allows investors to contextualize volatility. Silver is particularly susceptible because of its smaller market capitalization compared to gold and relatively high industrial demand. Even modest disruptions in physical supply can generate dramatic price swings, creating opportunities and risks for those positioned appropriately. Another point to highlight is regulatory oversight. Exchanges like COMEX and clearinghouses implement margin requirements, position limits, and delivery procedures precisely to prevent disorderly markets. While these safeguards reduce the risk of total systemic collapse, they cannot prevent extreme volatility if physical shortages intersect with highly leveraged positions. This is why reports of HSBC's exposure, whether fully verified or speculative, attract attention. Because a bank of its scale operating under tight physical conditions has the capacity to influence pricing and liquidity meaningfully. Analogies to other markets help solidify this understanding. Consider the oil market. If a major storage hub experiences a shortfall during peak demand, prices spike rapidly. Similarly, in silver, physical scarcity and delivery points, combined with leveraged shorts, can accelerate price increases faster than fundamentals alone might suggest. These dynamics are amplified in precious metals because of the thinness of the market relative to total notional value in paper contracts. Unlike large equity markets, a relatively small amount of actual metal moving hands can have outsized effects. Investors also need to understand backwardation and contango in this context. When silver trades in backwardation, it signals that physical demand is strong relative to future supply. Immediate delivery is more valuable than deferred contracts. Conversely, contango indicates abundant supply or lower immediate demand. Observing these market structures provides critical insight into delivery pressures and potential squeeze scenarios. Current reports suggest intermittent backwardation, particularly in Asian hubs, signaling elevated stress points. Finally, let's return to the big picture. The alleged HSBC silver margin crisis illustrates the fragile balance between paper markets and physical commodities. While headlines may dramatize numbers, the structural reality is that silver markets are smaller, more leveraged, and more interconnected globally than most investors realize. Delivery failures, margin calls, concentrated short positions, and surging demand in Asia all contribute to a volatile environment. Even if $312 per ounce is speculative, the underlying forces can create sharp, rapid, and meaningful price moves. Understanding these forces equips investors to interpret news, manage risk, and appreciate why silver remains one of the most intriguing and potentially explosive commodities in the financial system today. In summary, the HSBC silver margin call narrative, whether fully verified or speculative, shines a light on the critical dynamics of modern silver markets. The tension between paper contracts and physical delivery, the impact of concentrated short positions, the role of global demand, especially in Asia, and the mechanisms of margin calls and market leverage. Historical examples, such as the Hunt Brothers saga and the 2011 silver rally, demonstrate how structural imbalances can lead to rapid price movements. Investors who understand these mechanics, from backwardation and contango to ETF flows and delivery failures, are better equipped to interpret market developments and assess risk. Silver is not merely a commodity, it is a strategic asset whose value can be dramatically affected when leverage, scarcity, and global demand converge. The story of HSBC's alleged position serves as a reminder of the delicate balance in financial markets and the potential for volatility when that balance is disrupted.